Introduction to money printing. In 2008, the global financial system faced a severe crisis that caused the normal flow of money to stop. Banks no longer trusted each other, lending between institutions slowed down, and businesses struggled to access credit. This created a chain reaction that began to affect the entire global economy. As financial markets froze, central banks around the world were forced to step in and search for new solutions. Traditional tools, such as lowering interest rates, were no longer enough to stabilize the situation. This moment marked the beginning of a completely new monetary era. Central banks started using unconventional policies to inject money directly into the financial system with the goal of restoring liquidity, rebuilding confidence, and preventing a total economic collapse. What is QE? Quantitative easing, or QE, is a monetary policy where central banks purchase large amounts of financial assets, mainly government bonds and other securities. The purpose of these purchases is to increase liquidity in the financial system. When central banks buy these assets, they create new money electronically and inject it into the economy. This increases the amount of available capital, making it easier for banks to lend and for businesses and consumers to borrow. At the same time, QE expands the balance sheets of central banks significantly. This process also helps lower interest rates and supports overall economic activity during times of crisis. Global impact. The use of quantitative easing quickly spread across the world. The United States was one of the first to implement large-scale QE programs in response to the financial crisis. These actions helped stabilize markets and restore confidence. In Europe, the situation developed differently. The European Central Bank introduced not only asset purchases, but also negative interest rates. This meant that banks were effectively charged for holding excess reserves, encouraging them to lend more. Japan took yet another approach by introducing yield curve control. This policy allowed the central bank to directly influence interest rates across different time periods. Together, these global actions reshaped the financial system and defined the modern era of central banking.